attention. We have Bradley's here from a student organization, Beta Alpha Psi, and I'll let him tell a little bit about that and invite you to their first meeting.
All right, hello everyone. My name is Bradley Scott. I'm a Master of Accounting student here at SLU, and I'm the president of Beta Alpha Psi. So I'm here today to tell you a little bit more about our organization and invite you to a meeting that we're having next week. So Beta Alpha Psi is an honor society for finance, ITM, and accounting majors, and how it generally works is we have a representative from a local firm come in every other week and give a presentation about a topic that us members think is interesting. In the past, we've had topics like data analytics, tax reform changes, auditing, and also more like student-oriented topics like how to write a resume, interviewing skills, and things like that. And Beta Alpha Psi is really a great way to start seeing what you like, seeing what you don't like, and making decisions based on that, because it's always hard to make some of those decisions without all the knowledge. And it's also a great way to get in front of recruiters early. I know when I went in to interview with firms, it was nice to kind of know someone in the company when I was coming in, and that was very nice. And finally, it's a great way to meet some of your peers in a different setting and get to know them in a different way than you do just sitting by one or two people during class. And so with that said, I want to invite you guys all to our informational meeting next Thursday, September 6th at 3:30 p.m. in Cook 330. And we'll kind of go over more of what we do, what we're about, and all that. And you guys are also welcome to stay for our actual meeting at 4 p.m. and that'll go till maybe 5:30 or 6. And so with that said, does anybody have any questions about our club and what we're about?
Are your meetings like always on Thursdays at that time, or does it vary?
They're always on Thursday at 4 p.m. this semester. Yeah.
What's the GPA requirement?
To be included, it's 3.2.
So what you guys qualify for now is you could go and then you could pledge. You can't become a member until you're in your first 3,000 level major class, so whichever of the three majors you're in. But now is a good time, especially if you're thinking accounting, finance, or ITM. Now is a great time to go and, as he said, get exposed to some of the folks and some of the topics. So, and then he put this up here, so Gmail account, if you have more questions, feel free to email the Gmail account.
Thank you guys. Hope to see you all there.
Okay, thank you. Okay, on Tuesday, if you would, when you come in, sit where you want to sit for the semester. I'd like to try to get to know faces and names. And so you'll see today I use this extensively. And so sit, if you don't have good eyesight, you may want to sit closer, etc. And also don't forget, if you haven't already talked to me and you're going to use a laptop during class, you need to talk to me before. If you're using the e-text, whenever we look at stuff in the text, then you can pull it out. Again, I'm doing this because I've had students complain about, not that you're going to do it, but just for the heads up. So several of you have already talked to me about it, and there's an academic reason if you're taking notes, etc. But otherwise, no laptop. So I'm going to hand out the outline for the first 3 chapters. And you can utilize these outlines however it best suits you. Some students use them to take notes in class. Other students will take notes on paper and then transfer it to this later. Whatever works for you. If you're not going to take notes on it directly, you need to bring it to class, because I have examples that are in the outline that I'm not going to rewrite on the overhead for you to then copy down. So bring this if you're not going to use it. How many more do you need? Doing a terrible job this semester of guesstimating the weight of the staff. Okay. This also will have the assignments at the end of each of the chapter outlines. The assignment will be there, and we'll talk a little bit about that at the end of class. We'll see how far we get today, but if not, all of your homework for chapter 1 may be due on Tuesday. If not, if we don't make it far enough, then I'll let you know which ones you need to have done. Did everyone have an outline? Okay. So I had asked on Tuesday what your thoughts were about what accounting is, and didn't get anyone really to respond. So let's try it again. We said accounting is important, it's the language of business. So in your mind, what is accounting?
It tracks like your assets and liabilities.
Okay. You're going to be tracking assets and liabilities, and we'll define assets and liabilities if you're not familiar with those terms. What else?
Keeping track of the economic status of the company.
Okay, the economic status of a company, kind of like keeping score. So in a ball game, at the end, you want to know what the score is, who won, who lost. Well, in a business, the business needs to know how it's doing. They need to know if they're winning or if they're not winning. And if they're not winning, how many years have they not been winning? And then they may want to consider not being a business anymore. So accounting, again, is the language of business, very, very important function in a business. So basically, what accounting does, it provides information useful for decision making. So accounting provides information that is useful in making decisions in a company. So the accounting system has to capture and measure transactions that affect the financial position of the company. So someone has to make a decision, this affects the financial position of the company. We need to measure it in terms of dollars. And then after they do that, it has to be recorded in the accounting system. And then periodically, that information is summarized. Depending on the needs of people, summarized. Maybe someone needs daily information. Maybe someone needs quarterly information. Maybe someone is only interested in annual information. The important step in the accounting system is the communication then. Communication of this information to the folks that need it, and this is done in this class. In a minute we'll talk about financial versus managerial. This is done through our financial statements. Communicate info through financial statements. So you're going to learn about how this information gets captured and measured. We're going to learn how to record it. We're going to learn how to summarize it, and we're going to look at the financial statements that are used to communicate the information. And then the analysis step. So the different users are going to be using this information. They're going to analyze it, and then they're going to make decisions based on the information. So users of accounting information. Who can you think of that uses accounting information, would need to use this information?
Creditors and banks.
Okay, creditors. Which creditors could include banks. So if a company needs to get a loan, they're going to have to fill out a loan application. They're probably going to be asked to provide financial statements, financial information.
Stakeholders,
Okay, who would be stakeholders?
I guess, who are affected by the decisions.
Okay, so let's figure out who, in a company, who would be stakeholders in a company? Management? How about about employees? Do you think employees use financial information that's publicly known? Okay, if it's a publicly traded company, employees will be able to access the company's financial information that gets published. So if you're working for a company and you want to see how they did. Labor unions will use, again, if it's a publicly held company, labor unions will use that financial information to help negotiate a better contract. Just heard on the news coming in today that the steel workers, Granite City Steel, they're trying to negotiate a contract, and with the tariffs that have been imposed on steel coming into the country now has increased the prospects for U.S. steel companies, and so the union is not very happy, the employee's not very happy with the package that's being offered because of the projected profits that the U.S. steel industry in that particular company is going to have over the next few years. So they're using the public information that they have about a company to help them negotiate a deal. Government agencies, the IRS being one of those. So if it's a publicly traded corporation, they're going to have to file an income tax return as an entity with the IRS. We'll use this accounting information. We're going to talk one of the first few chapters about the role of what's the major role that some accountants play in their auditors. So external auditors to a company needs the financial information. Every publicly traded company has to have an audit by an external CPA firm. And that firm has to come in and go through records on a test basis so that they can develop an opinion on if the financial statements fairly present the company. So auditors will be using this information. Anyone else think of someone else? Why would Kmart want to look at Walmart's financial statements? Anyone heard of Kmart? Are they doing well?
Are they going out of business?
They're closing a lot of stores. So competitors will look at, again, if it's a public traded company, so someone may say, well, how is Walmart doing it? Why are they doing so well? Well, whatever information they can get from the public filings, they'll take that information, and start doing some analysis and compare it to their company. And they may be able to discover, what it is, what's the magic behind what makes Walmart go. Basically, it's because they're willing to take a lower profit margin on an item, because if they have a reduced price on the item, what are they expecting to be able to do? Sell more. So if I lower my price, I'm going to get more customers. So they're going to make up for that willingness to take 20 cents less on an item, because they plan on selling it to 10,000 more customers. And so they've made up what they lost by reducing their price or being able to negotiate a good cost. So all kinds of users. And one day, we didn't put back up to stakeholders, investors, the stockholders, potential stockholders. So one day when you graduate and you get a job, you'll be making money, you may want to invest in a company. And so you'll be able to get the public, again, if it's a publicly traded company, you'll be able to get the financial information and try to decide which company that you may want to buy stock in. So there's lots and lots of users of the accounting information. A lot of people think it's just accountants that use the information, and it's not. Okay, financial versus managerial accounting. So this course is financial accounting. And our focus here is an external focus. So we're mainly focused on gathering information for external users. So everything that we're doing in this class is for a publicly traded corporation, and it's with an external focus. The financial statements, companies have to present those once a year. Again, we're talking about a publicly traded company. Managerial, most of you have to take the second accounting class. It's called Accounting for Decision Making. Used to be called Managerial Accounting, but the focus here is internal. So this is, let's try to figure out how much this product is actually costing us to make. So you'll learn how to different costing techniques, allocating costs through different departments in a company. A lot of students that aren't going to go into accounting seem to like the managerial accounting course because most other majors see more of a need for this course than this one, but you have to have this one first to understand basic accounting. A lot of accounting students, when they after they've taken both courses, will come back and say, you know, I really like financial. So if you are thinking about accounting and you get into managerial and you're like, okay, this is really different, because it is. Don't change your major because you're not liking the focus of this, because the main focus of an accounting major, you're going to take several classes that deal with this external focus with financial accounting. So again, this class we're externally focused on preparing accounting information. There are many, many, many types of business organizations, lots of hybrid types. We're only going to talk about 3 of the main ones. The first one, they're proprietorship. So what is a proprietorship?
It's just like usually one person that just owns it
Okay,
and operates it.
one owner and operates it, and typically it's not incorporated. So typically it's unincorporated, although you can incorporate a company if you are a single owner, a proprietor, but a proprietorship is typically an unincorporated business owned by one. If you own a business and you're a proprietor and you decide, I want to be a corporation, now you're going to be a one-party corporation. Okay? And we'll talk about the benefits of being a corporation. In a proprietorship, the owner has what's called unlimited liability. Unlimited liability, which means the owner's personal assets are at risk. So if the business fails, creditors of the business can seek personal assets from the owner. That's the biggest drawback about being a proprietor, is that risk, that unlimited liability. A proprietor is taxed at the individual level. So a proprietor fills out their individual income tax, claims a business, calculates the income, and then they pay taxes based on their individual tax. Corporations have to actually file a return as an entity and pay taxes as an entity. So proprietorship is different here. How about a partnership? How many people own a partnership? 2. 2 or more? Again, it's unincorporated. It's an unincorporated business owned by 2 or more partners. The general partners, again, have that unlimited liability. So that's, again, the drawback of a partnership. You have to be very trusting of the people you go into a partnership with, because if a partner is acting in their normal role, and let's say their normal role is they go arrange loans at the bank, and a partner goes down and arranges a loan at the bank, and the bank has every reason to believe this is for the partnership and then that partner takes the money and skips town, the other partners are liable for that debt, okay? So you have to be very, very careful who you go if you're gonna form a partnership. This is also taxed at the individual level. So a partnership has to file an information return with the IRS that lets them know who the partners are and what share of the income or loss that they should be reporting on their individual return. And then the individual, whenever they file their individual taxes, has to complete the paperwork necessary and then claim that as either an income or a loss. The first two types of business entities are not what this course concentrates on. Now, some of the stuff that we do is appropriate for both, or for all three types. But the focus here is a corporation and a publicly held corporation. There are some corporations that are not publicly held. A corporation is a separate legal entity, different from the other two. It can sue and be sued in its company name. A corporation has to pay taxes as an entity. So if you're a stockholder in a corporation, that would be the owners, would be called stockholders. Different from if you are a partner in a partnership. If you are a stockholder in a corporation, you're not going to have to file and pay taxes based on the corporation's income. You're only going to pay taxes on any distributions you receive in the form of dividends. Okay, so the taxation is a lot different between a proprietorship, partnership, and then the corporation. In a corporation, you can transfer ownership easy. If I own a share of IBM stock and you want to buy my share of IBM stock, we enter into a transaction and nothing happens at the company level except there's now a different stockholder listed as an owner in the company. But the company doesn't cease to exist accounting-wise, which is what happens in a partnership. If you change partners, anything you do to change, if someone dies, if someone leaves, if you bring in a new partner, that accounting for that entity stops, and now you have to start accounting for a new entity. Not in a corporation, very easy to change ownership. It's easier to raise cash. So if a company needs some money to expand, it's easier if you are a corporation because you can issue bonds, a form of debt, which we'll get to in a later chapter. You can issue stock. You don't have that in a partnership or proprietorship. The biggest advantage is the owners have limited liability. The owners have limited liability. So for the other two, we said the owners had unlimited liability. The stockholders in a corporation have limited liability, which means they can only lose what they've invested. Creditors of a corporation cannot come to the stockholders and ask for them to pay the debts of the company if the company wasn't able to pay its own debts. Okay, it can't happen in a corporation. That is typically why businesses become incorporated, because they want this advantage. Because it is a good protection. Now, as we go through the class, again, everything we talk about focused on publicly traded corporation, and again, some of it applies to both for accounting, but not everything, because you don't have stockholders in a partnership or a proprietorship. One of the big disadvantages that you hear people talk about is what we call double you'll hear people talk about double taxation. Double taxation. What that means is that the company has to file an income tax return, and the company has to pay taxes as an entity. And then, if the company distributes what are called dividends to stockholders, the stockholders now have to report the dividends as income on their personal return, and now they have to pay taxes on those dividends. So sometimes you will hear that term double taxation, and that's what folks are referring to. Any question on the three forms? And again, there's lots of hybrids, which if you have taken the legal environment of business class, or if you're in it now, you'll go over some of more of the hybrid type forms of a company now. Okay. If you wanted to start anyone in here have their own business? Already have a business? Okay, so if you wanted to start a business, what's the first thing you would have to have? If you want to start a business.
Money.
Okay, you would need money. Before money, though, what would you need?
Assets and
What's that?
assets and resources.
Access to resources. What else? What's critical to a company?
An idea?
An idea. Okay, so the first thing you have to have is a good business idea. Okay? And then after you have that, you guys mentioned access to resources, cash. So we'll call that financing. So you would have to figure out, how am I going to finance this brilliant idea that I have? Am I going to get the money from going to banks? Am I going to get the money, if I'm not a corporation, am I going to ask friends to help fund this for me? Now we've got GoFundMe and all those other sources that people can get for help to start a business. So we call these financing activities, and so for the financing activities would be borrow from creditors. So creditors are the folks that are lending money or you owe. This creates a liability. So a liability is an obligation that you have. A corporation could also get financing by issuing bonds. Issuing bonds. Payable. This creates a liability. And we'll get to a chapter much later in the course looking at bonds. So both of the first two means you're borrowing money. The first one is typically from a financial institution. The second one could be investors. People that are wanting to buy bonds in your company, and then they're loaning you money, and then you have to pay them interest and then repay them at some point. Another way to finance is to issue stock. Okay, so again, this would only be, bonds and stock would only work if you're a corporation. You don't do those if you are a proprietorship or a partnership. This does not create a liability. This does not create a liability if you issue stock. You now have stockholders when you issue stock. And they are owners of the company. You do not have to pay them back. Sometimes this is referred to as equity securities. Equity securities. We'll get to equity in a minute. So you do not have to pay your stockholders back unless you choose to pay out dividends, but you don't have to pay dividends. Okay, so once you know where you're getting your money, so you've got your financing, then the next thing there is we're going to have investing activities. And when you're doing investing activities, this is obtaining resources needed to operate your business. Okay, obtaining the resources needed to operate your business. And another name for resources would be assets. So do I need a building? Do I need equipment? Do I need office equipment? Do I need a copy machine? Those types of things. What do I need resources to be able to operate my business? Then we've got the last category there are our operating. Okay, so our operating activities. These are your day-to-day activities where you are generating revenue and incurring expenses. So many of a company's activities will fall under operating activities. So again, this would be your normal day-to-day operations, as they call it, where you are generating revenue, whatever your company was designed to do, and then you're incurring expenses along the way. So my salaries that I pay my employees would be considered an operating activity. My utilities that I have to pay would be considered an operating activity. Those would be expenses of the company. The revenues would be, I sold $10 million of my goods to my customers. That's the revenue that would be coming in for the company. And we'll talk about revenues and expenses in a few minutes. Now to the accounting equation. This is the one thing in this chapter that you cannot leave this chapter without understanding. Okay, I told you how this course is similar to a math course in that it builds. If you don't have an understanding of the accounting equation as you leave this chapter, the next chapter, and especially chapter 3, become much more difficult. So you have to really understand the accounting equation. Okay, before we get into the terminology for the accounting terminology for this equation, it's an equation, so if we have an equation, we have to keep it in balance. So this has to stay in balance. So in general terms, a company has the resources. So they've got their building, they've got their land, they've got their delivery vehicles. And then they had to get those resources somehow. So on the right side of the equation, we say we have the claims to the resources. So how could the company have gotten the building? Well, they could have incurred a liability. They could have borrowed in order to get that resources. So one of the claims to a company's resources would be the creditors. Okay, so you generate the liabilities. Another way they could have gotten the resource is through stockholders' equity. Through stockholders' equity, through their stockholders, by issuing shares of stock and getting money from stockholders. Resources, another name for resources in accounting lingo, would be their assets. So we've got our assets on the left side of the equation. On the right side, we've got liabilities and stockholders' equity. Abbreviation-wise, it's A is equal to L plus E. And now we're going to start listing some of these assets And then as we go through the course, more will get added to the list, but just to get started on the basics here. So the first asset that you normally see in a company's financial statements on the balance sheet, we'll get to the financial statements in a little bit, would be cash. Okay, so cash is considered an asset of the company. It's a resource that the company has. Accounts receivable. Who can tell me what an account receivable is? Abbreviation is A/R, so I encourage you to learn abbreviations because it makes note taking. Yeah.
Is that when you have like a customer who doesn't pay you in cash right away, so then you're able to like take money from them?
So you have a claim to receive something later. So an account receivable is where you have sold your goods or services, what we call on account or on credit, which means they haven't paid you yet. So you have an asset in the form that you have a claim to receive money in the future. Okay, so accounts receivable, a lot of companies sell their goods and services on account. And then they give the customer 30 days to pay them on account, pay them that money that they owe them. But that's an asset for the company. Inventory. We're going to get to, not until chapter 5 will we get to the type of company, a merchandising company that has inventory. Up until that time, we're only going to be talking about a service type company, so they're providing services. They're not selling goods. But if the company is selling goods, the goods that they're holding to resell is called inventory. And that's an asset for the company because you're going to be able to take that and convert that into cash at a later time, hopefully. I'm going to throw one in here. We're going to get to it more when we get to chapter 4, but I think it may show up in homework just as where to put it. We've got something called prepaid expenses. Prepaid expenses. And so this is a resource for the company because what this means is the company has paid ahead of time for something that they're going to get a benefit later. So you may have to prepay for your insurance. Your insurance company may require that you pay 2 years in advance for your insurance. Well, when I pay that, I can't call it insurance expense today because I'm going to have a benefit now for 2 years. So instead I have to put it into this asset account called prepaid insurance, would be the specific name, and then as I use it up, we'll call it expenses. And we won't be doing that until chapter 4, but again, it may show up where to put that, but that's an asset for the company. Then we have our what we call longer term type assets. So if you have land that your building is setting on, if you have a building, if you have equipment, okay, those would be longer term type assets. And again, this is not meant to be an exhaustive list, just to get us started. So the definition of an asset is that we have a resources expected to benefit the future. These are the resources that we have that we expect to benefit us in the future. And as we went through these, I tried to point out how you're going to get a future benefit from these. Now to liabilities. So a liability is an obligation that you have. Most of the liabilities you're obligated to pay money. But I'm just going to limit it to obligations because we have a type of obligation that does not mean you have to pay something. It means you have to do something, perform services, deliver the goods that someone has purchased. But we'll get into that later also. Accounts payable. Abbreviated A/P. What's an account payable? What's an account payable?
Something that a company owes to another company.
Okay, you owe another company. Okay, so an account payable is where you owe another company. So it's the flip side of an account receivable. Okay, an account receivable, the company was the seller, they sold goods on credit or on account. The company that bought those goods, or individual that bought those goods, whichever, has an account payable, because now they owe money to that other company. So this is an obligation, it's a liability of the company. We also have what are called notes payable, N/P. Also, we could have notes receivable, which I didn't include yet in the list, but a note payable is just a more formal obligation. So if you sign a legal document, a note, it says, I owe this much, and I'm making these payments, and I'm paying this interest rate, and it's due this time. That's a formal obligation. Much different than if you go down to your office supply store and you've made an arrangement that you can just go and pick up or order office supplies, they'll send them to you, and then they'll bill you for them later. That's an account payable. But if you went down to the bank and you borrowed money, they're going to make you sign a legal document, what's called a note. We'll get into a chapter later on that, but you could have that is a liability, again, N/P. Wages payable. Income taxes payable. So far, what's been the common word here? Payable. So if you see the word payable, it's a liability. And then we have a type of liability. So all of those, the company owes someone money. We have what are called unearned revenues. And because it's got the word unearned in front of it, that makes it a liability. This is the one that you don't pay back in cash. Okay, all the other ones you owe someone some money. An unearned revenue, I gave the example of a prepaid expense with the insurance. Well, if you're the insurance company and you receive 2 years of premiums in advance from your customer, you cannot call that a revenue today. Just like they can't call it an expense today because they haven't used it, you can't call it a revenue today because you've got to do 2 years of providing coverage for this company. So it's not a revenue today. It's going to be taken into revenue over that 2-year time period. So until you start earning, or until you earn that unearned revenue, it stays as a liability. Again, it's an obligation to do something, not an obligation to pay money. So if you see unearned in front of it, that's going to be in the liability column. And then we've got our equity. Since I'm kind of squished there, I'm going to take my equity here. So one of the components of equity is stock. So when I issue stock to my stockholders, I'm going to have an account in my equity section where I'm going to keep track of that. So I've got a stock, it could be called common stock. And then there's a second component of equity called retained earnings. Retained earnings. This is typically the one that gives students trouble understanding. But what this is, it's the accumulated earnings of a company since it began, minus any dividends. It's the accumulated earnings of a company since it began, minus dividends. And a dividend is a distribution to the stockholders. Okay, dividends are distributions to your stockholders. What affects retained earnings? Revenues increase retained earnings. Now I'm going to use RE as an abbreviation for retained earnings. Revenues increase retained earnings. Now I'm going to throw in the word indirectly increase. And we'll understand that when we get to chapter 3. Okay, but revenues indirectly increase retained earnings. Expenses then indirectly decrease retained earnings. So revenues and expenses, that would be your accumulated earnings of a company. So if your revenues exceed your expenses, what would the company report? What would we call that? If revenues exceed their expenses. Net income. If revenues are less than the expenses, net loss. So a company can have a net loss or a net income. So it's the accumulation of all of those since it began. And then minus any dividends. Dividends decrease retained earnings. And notice I wrote that as a separate item because dividends are not an expense of the company. Dividends are not an expense of the company. Okay? They affect it in the same way as an expense, but a dividend is a distribution to stockholders. It's not an expense of the company. So revenues minus expenses is what gives us either a net income, and I'll use NI for net income, or a net loss, and I'll use NL for net loss. It's important that you understand how these three things affect the retained earnings. What retained earnings is not your cash. So if I said, how much cash does the company have? You're not going to look at the retained earnings account because just because the earnings have been retained in the company doesn't mean that it's in the form of cash. Okay? You guys ready for a puzzle?
Oh, yes.
Oh, yes? Oh, yes. Okay. Elvis and I. Name of a movie?
King and I. Sorry.
King and I. No, that's, yeah, no, you yell it out. You don't have to raise your hand. The King and I? Okay. Sometimes these are not as good as other ones, so sometimes I'll agree that some of these are lame. And sometimes these have shown up on exams as bonus points. Someone's going to start writing them out now. Come on, Jeremy. Jeremy is a grad student that's here taping for someone who's not here today. He's an accounting major, so he was in my class, so.
I don't remember. It's been 3 years.
It's been 3 years, but you know how that hurts?
I'm sorry.
I was over in Bush Student Center in the dining area one day, and I came up and sat down next to a table, and a couple of students from my class were at the table, and it was so funny because they were actually doing these with their friends, showing their friends. And they started laughing when they saw me. They're like, "Guess what we're doing? We're showing these." So you can share these.
Is it a broken elevator?
Out of order elevator. Very good. I think you're the first one that's ever out of order elevator. Broken is the same, is out of order. And,
Oh.
well, the next one on here is actually, I've already given the answer away because I had to do it to the class, so we'll do one more. So what's missing? C. Long time. No see. Okay, now you've gotten the hang of puzzles. Got a bonus one today. That'll make up for the day that I'm trying to rush to get through the material. Okay, so we finished talking about retained earnings. Now, if you would, in your book, so if you've got the e-book and you want to pull it up, we're going to look at page 16, financial statements. Okay, so this is a good page. One of your homework problems will give you financial statements, and it will have missing items, missing numbers. And you'll have to figure out what the missing number is, and you have to have an understanding of how these four statements tie together. So if you see on page 16, you've got four financial statements, and then you see arrows that's showing you how the statements tie together. So that will be important when you do one of the homework problems. So remember this page. So it's the first financial statement there. Okay, so some people say, well, why are we starting with the financial statements if when you listed what we do in accounting, that the financial statements close to the last step? We start with the outcome of the financial accounting process because it's easier to explain looking at financial statements. And then we'll go back in chapter 3 and we'll start at the beginning of the accounting cycle process so that you can see how the numbers then ended up on the financial statements. But we start here because it's a good place to start learning, again, some of the terminology, etc. So your first statement there is called the income statement. And the first thing to know about this is sometimes it's not always called the income statement. Companies don't always use that. They may call it statement of earnings, so something similar. So the income statement reports revenues and expenses for a period of time. Okay, so the income statement reports revenues and expenses for a period of time. So if you look at the heading for the statement, it's got the name of the company, then it's got income statement, and then the next line tells you the time period. And that time period is very important, especially if you're looking at income statements and you're trying to compare companies. This is income for 1 month. So if you miss that and you're comparing it to another company that was reporting income for a year, you may think, well, this company's doing terrible. But yet if you caught that it was for a month, then they actually may be doing better than what you're looking at results of another company for a whole year. So time period is very, very important to pick up on. Sometimes it's for the quarter ended. For the year ended would mean it's for the whole year. And you always have your revenues listed first. And in these first 4 chapters, we're going to have very basic revenues because we're not going to get into a merchandising company that sells inventory until we get to chapter 5, and then our income statement will really change. So it's going to be pretty basic in these early chapters. So your revenues, again, that's what you generate from selling your goods or services to your company or to your customers. Minus expenses. So if I had more than one type of revenue, I would list each type of revenue. Expenses, so companies typically will have 1, maybe 2 types of revenues. They could have 100 different expenses. So you're more likely to see a lot of different expenses. So if you notice in the book here, they list these different expenses. So we got the salary expense, the rent expense, supplies expense, depreciation expense, which we'll get to in a later chapter, interest expense, and insurance expense. There are many more expenses that a company could have. And then this gives you net income or net loss. And we already said if the company's revenues were greater than the expenses, then the company has net income. If the expenses were greater than revenues, the company would have a net loss.
How come the expenses aren't in parentheses then?
They're in parentheses on here because those are going to be, when you say in parentheses, what are you looking at?
On the income statement, on the left-hand side of the, like, there's two columns.
Yeah, you're looking at an ebook and that's not what our book has.
What?
That's not, can you show me that after class?
Sure.
Yeah, because that would typically mean you're going to subtract it.
Okay.
Yeah, I just don't typically see that on an income statement, so I'd like to take a look at that. It may be in a different format than what ours is. So what, in the book, the income statement, you've got your revenues, you've got your expenses in an inner column, and then you notice that there's a total expenses that goes back over to the right column, so this one has 2 columns. The purpose of the multiple columns is to put the detail in the inner column. So someone may just be interested in looking to see what were total revenues and expenses. They may not care about what the different expenses were. They can quickly look at this and see how much total expenses are without having to get in the details of what those were. And then in this case, we had income of $28.60. Any question on the income statement? Okay, the next statement then is called the statement of retained earnings or retained earnings statement. And again, I'm using RE for retained earnings. This one reports changes in retained earnings for a period of time. And the time period is going to be the same as for the income statement. So again, the heading, the name of the company, the name of the statement, and then for the month ended. For this statement, we're going to start with our beginning retained earnings. And we're either going to be adding the net income, and notice that that's a tie-in to the income statement. So the income that you computed on your income statement is going to come down to this statement, or you would subtract if you had a net loss. So beginning retained earnings plus net income or minus net loss, minus dividends. So if you remember, we said revenues, expenses, and dividends affect retained earnings. The revenues and expenses are through the income or loss number. And then remember, dividends not an expense, so it's not on the income statement, so that has to get subtracted separately here. And then that gives us what's called ending retained earnings. So if I'm a brand new company, what would my beginning retained earnings be at the start of this year that I started my company? 0. What would be my beginning retained earnings for year 2? If I was doing this for my year 2 of operations, what am I going to plug in for beginning retained earnings? Ending from the previous year. Everyone follow? So the ending retained earnings from one year becomes the beginning retained earnings for the next year. So keep that in mind when you're doing the homework. And then that ending retained earnings ties to the balance sheet, because the next statement, we're going to be looking at a balance sheet. And that ending retained earnings now is going to appear on the balance sheet. So the balance sheet. Sometimes it's called the statement of financial position. Again, you just have to get, when you're looking at published financial statements, published annual report, you just have to know some of these are going to take on a different title. So the balance sheet, this reports the financial position of a company at a point in time. So different from the first two that reported information for a period of time, this one is at a point in time. So the balance sheet is more like a snapshot picture of a company at one point. So when you look at the balance sheet, the balances on this balance sheet were only valid maybe for that one day. Some of these are going to change the next day. So the other ones were for a period of time, this one is a point in time. So this is going to list our assets, so this is where you'll see the title assets, and then you'll have your assets listed. Then we've got our liabilities. And then we've got our equity. So we called it the accounting equation when we looked at this a few minutes ago. It's also called the balance sheet equation. So the accounting equation is also called the balance sheet equation because this is where you find the components, assets, liabilities, and equity. So assets have to equal the liabilities plus the equity. So if you look at the balance sheet in your book, you add up, they've got the assets totaling 21,910. And then if you look at the bottom, total liabilities and stockholders' equity total 21,910. Those have to balance. If you do a balance sheet and that doesn't balance, that tells you you've done something wrong. Now, you could have a balance sheet that balances, but you could still have something wrong, okay? So just because it balances doesn't mean you've got it 100% correct. You can make similar errors in different areas, or you could misclassify something. You could misclassify something as equity when it should have been a liability, but your financial statement is still going to balance. So notice that the ending retained earnings, and this is key to the homework, some of the homework problems, that ending retained earnings is what you want on this balance sheet. Everyone follow? Notice on the heading, on the date line, it just says October 31st. These are the balances for October 31st, point in time. And then the last statement will be the statement of retained earnings. Statement of cash flows. This one we're not going to do a lot with until we get to the end of the course, but it's introduced here. Some people say this is a critical statement. Because what does a company need in order to stay in business? Money. They need cash. So if I'm out there and I'm making all these sales on credit, what happens if I never collect from my customers, if they never pay me? My income statement looks great because I've got all these credit sales. But in reality, I could be going out of business because I'm not collecting the credit sales from my customers. That's why some people say this cash flow statement is so important, because this one now actually reports the inflows and outflows of cash. And again, this one goes back to a period of time. Inflows and outflows of cash for a time period. Now, the cash flow statement is broken down into 3 subsections, and they're actually the same things that we talked about. What would you need to do if you were going to start a business? We talked about activities. We need financing, investing, and operating. On the cash flow statement, you're going to have the inflows and outflows broken down. The first one is the cash flows from operating activities. Now, on this one is where you will see brackets in your book. That means that's an outflow. Means it's an outflow. And then for each of the categories, you're going to have a net cash inflow or outflow from that particular area. So if you look in your book, you've got net cash provided, which means a net cash inflow from operating activities was $5,700. We had 1 inflow and 1 outflow. And then we've got cash flows from investing activities. And again, you can have inflows and outflows here. This one had 1 outflow. You purchased office equipment. The only things that go on here involve cash. So either cash was coming in or cash was going out. So if I made a credit sale, that's not going to show up on the cash flow statement until I collect from that customer. Everyone follow? So I could make a credit sale today in August. If I get a cash flow statement for August, that's not going to show up until I collect it. If I collect it in September, it will show up on September's cash flow statement. And then we've got the cash flows from financing activities. And again, you're going to have inflows and outflows here. And then at the very end, you've got net increase in cash. So the 3 subtotals are going to be added together. So you've got your cash inflow from operations, you've got a cash outflow from investing of 5, and you've got a cash inflow of financing of 14.5. You net those 3 numbers together. That gives you your net increase or decrease, could have been a decrease in cash. And then you reconcile that. You take your cash at the beginning, since this was a new company, cash at the beginning would have been 0. And then in this case, we had an increase, so we would add that to our cash beginning balance, and then that gives us the cash at the end of the period. And notice that that is the same number that appears on your balance sheet for cash. Any question on the financial statements?
Can you say that last part again about those 3 numbers for the statement of cash flows?
Yeah, so the statement of cash flows, you've got net cash inflow from operating of $5,700, and then you've got net cash used of 5 from investing, and then you've got net cash inflow provided of 14.5. So you take those 3 numbers and net them together, and then that gives you an increase, a net increase in cash of 15.2.
Okay.
Those are the 3 numbers you would want to net together.
And you said the parentheses means subtraction?
Yeah, that would have been an outflow.
Okay, perfect, thank you.
Any question on the financial statements? Okay, let's look at the homework section so I can explain how the homework works. And we'll do the annual report on Tuesday. Talk about that. So on your homework, you have it at the bottom of that outline. If you turn to page 28, you'll see this first section is labeled brief exercises. Everyone see that? So in the homework, when I list that as EE. So you need to do brief exercises 3. The very first number is the chapter number. So brief exercise 1-1, that's brief exercise chapter 1, number 1. When I put them in the outline, I'm just using that second number. I'm not repeating the chapter number. So you need to do brief exercises 3, 4, 6, 7, and 9. It's important that you're in the right homework section because a brief exercise, the word brief, means it's not going to take you as long as a problem or as an exercise. So you want to make sure you're in the correct section. Then if you look at the next one is EX for exercises. So if you go to page 30, you'll see the exercises. Again, E1-1, the first one is the chapter number. So now in the exercise section, you're supposed to do 9 and 10. 9 is the one where you're looking at the tie-ins between the financial statements. And I will also tell you throughout your homework in this book, when they leave you some unknowns, you cannot necessarily do them in alpha order. Okay? So you may not be able to do A before you do B. Everyone follow? So if you get stuck, move on to another one because it may be that you have to come up with an answer for L before you can do B. Okay, so you can't always do them in alpha order. And then, if you go to page 35, we have problem set A. So I've got 2A, so we're in the problem section, and you're going to do problem 2A, which is there at the bottom of page 35. Also, when you're doing homework, the instructions are typically after the lead-in to the problem. So be careful especially when you're flipping pages. And sometimes you may go, well, what am I supposed to do? This has no instructions. Well, this is an example. Problem 2A, you have to flip the page over now to see what you're supposed to do. Everyone see that? The instructions are actually at the top of the next page. CT stands for critical thinking. So if you go to page 37, you see the critical thinking section. And for Tuesday, you need to have critical thinking 1. 1-1, again, the first one is the chapter number. Prior to the brief exercises, if you flip back, we don't have any in this chapter, but on page 27, there's also a question section of homework. So if I have a Q, that means you're supposed to answer the question. We don't have any for this chapter. Okay, so for Tuesday, sit where you want to sit for the semester when you come in. I'll pass around a sign-up sheet and then have all of the homework for chapter 1. And then what I will do is I will shuffle the index cards and call on you and we'll start the participation process. Don't forget, for your 10 points, come in to see me. Have a good weekend.
Thank you.